1-800-Flowers is a stock that's down over 70% year to date. And I actually think after doing a full valuation model on the company that this might be one of those overlooked opportunities as a share price might have overcorrected in this environment. And that's what I'm going to cover in this video. But first, let me run the intro. What's up, guys, and welcome back to the channel. Let's get right into this one. You can see that 1-800-Flowers is down over 70%, and it had two major declines. You can see that they had a major decline early in this year, I would say around February. That's probably when they guided to lower results, and they had lower results in September when they released results as well. And this is sort of a cutout from seekingalpha.com. I always just like to look at this just to see what Wall Street and the Seeking Alpha investors are thinking about the security. Notice how Wall Street and retail investors seem to be kind of hot on this stock. So this sort of prompted me to create a valuation on the company and see what I think. Now, here's my model that the Patreons get access to. This is just historical information. Notice that the share price decline of over 70% is very close to the net income decline of approximately 73%. And the reason why the net income declined was because they just had higher COGS in this current economic environment. But the one thing that I do want you guys to pay attention to is notice how well they managed operating costs in this environment in spite of those higher COGS. So effectively what I'm saying is management should be noted for how well they've been able to manage their costs. It's a tough environment, and they've been able to do very well and protect that bottom line somewhat. It is down over 70%, but you got to give them credit where credit is due. And the one thing that really surprised me, I did want to point out, is that notice how the revenue actually grew 4% in their fiscal year 2022. So we have a challenged consumer environment. They've been able to maintain those pandemic level increases revenue. So that's really interesting. It's not something that I'm going to forecast out, but once again, it's another win for the management team. And you can see here that they actually called it out when they released earnings recently. They said that their growth for the year illustrates their ability to retain and build on the gains that we achieved over the past 2 years. And so effectively what I'm saying there is that the pandemic bump was sustained. There's a lot of these online type of companies that had pandemic bumps, but then of course you're starting to see that come back to sort of normal. But it's interesting that they were able to sustain it, at least in fiscal year 2022. And they also called out what I thought was the reason for their results to be challenged in fiscal year 2022. You can notice that they said inflationary cost increases continue to pose challenges for them both in the fourth quarter and in the full year. And that's exactly why I expected that the results would have been down on the bottom line. But the question is, what does their guidance say? Because I kind of need their guidance to at least have a foothold of how I want to forecast this business out into the future. And you can see here that they're saying that the company is only going to be providing guidance on a quarter-over-quarter basis, and they expect their first fiscal year 2023 revenues to be down between 3 and 6%. I actually think for the full year, revenues are probably going to be down closer to 10% overall because we're continuing to increase rates, and I do believe that the consumer is going to pull back further than this. Other thing is, notice that they're going to try and protect that bottom line and that cash flow a lot more in this year. So what they're saying is the company anticipates reduced capital expenditures as well as lower working capital needs compared with the prior year. The company expects to generate substantial positive year-over-year free cash flow. So in other words, they're liquidating inventory. That's really what they're doing, and they're not reinvesting into this business in this current environment. So they might be flush in cash at the end of the year. So that suggests, could there be a buyback in the future? I don't know. I'm not forecasting anything out, but there could be an upside surprise for us at the end of fiscal year 2023. Now, the question is, how exactly am I modeling this out? Well, you don't have to wait any longer. I'm going to show you how I'm doing it. You can see that I'm being quite a bit more pessimistic than the market on this name right now. So in fiscal year 2023, I'm expecting revenues to come down 10%. And in fiscal year 2024, I'm expecting revenues to come down by another 5%. And they only start increasing revenues in 2025 and beyond. So I might be a little bit more pessimistic on the top line than other people who are valuing this company. But then the other thing that I want to show you is I'm also very hard on the bottom line, because notice that their COGS as a percentage of revenue in fiscal year 2023 is actually higher than what they achieved in 2022. So I'm anticipating, and potentially even conservatively to a fault, anticipating lower gross profit margins in fiscal year 2023 I don't peel that back in fiscal year 2024, the gross profit margin only starts increasing in fiscal year 2025 and beyond. So you can see operating profit margins are just 6 and 5 in 2023 and 2024, down from 42 million in fiscal year 2022. So that's how hard I'm penalizing their results going forward, at least into the next 2 years. But why am I being so pessimistic on this? Because I do believe that despite this pessimistic forecast, the valuation is so low, or the share price is so low, that still the current share price as a percentage of their intrinsic value is much lower than 50%. And I want to show you that. But before I do, I just want to point out, guys, that approximately 80% of the watch time on this channel is coming from people that are not subscribed to the channel. So guys, if you have an opportunity, please hit that subscribe button. Now let's dive right into the valuation. So I'm using a very low multiple. I think this company deserves a 15 times multiple, but just to prove the point and drive the whole concept home, that I'm using a terminal multiple of 12.5 times earnings. I'm completely penalizing them for the debt that they have on their balance sheet. So I'm subtracting $2 from the valuation of $17, and I'm getting to an earnings per share valuation of $15 per share. That reflects 45% of their intrinsic value, which is what the current share price relative to the EPS valuation reflects. So very interesting. I'm going to try and learn more about this opportunity, but I do believe that this could be one of those stocks that ends up in my portfolio. Now, how do you get access to that model that I just walked you guys through, and that full valuation, and all of the other models that the Patreons have access to? Well, you can get access to all of that at the lower tier of the Patreon. I make it super cheap because I'm not really trying to make money. I'm trying to educate you guys. But the other thing is, if you do want to join us for a live epic presentation every month, you can join us at that upper tier of the Patreons. Now, the other thing that I do want to point out to you guys is that 1-800-Flowers is not the only opportunity that I'm seeing in this market. I actually recently did a video on Paramount. That's another company that I'm seeing quite a bit of value in, and it's a name that Warren Buffett's Berkshire Hathaway actually purchased into. And so I've actually linked that video right here.